Hi, I'm Marisa Barlas, Associate Director, Advancement Gift Planning at York University. Thank you for joining us today for our very first special life skills series, Wills and Wealth Seminars, on the topic Tax Effective Wealth and Estate Planning. As this event is virtual and we're not all gathered in the same place, I recognize the following land acknowledgement might not be for the territory that you're currently on. And if that is the case, I ask that you kindly take the responsibility to acknowledge the traditional territory you are on and the current treaty holders. The website native-land.ca is a good resource for that. As a member of the York University community, I recognize that many Indigenous nations have long-standing relationships with the territories upon which York University campuses are located, which precede the establishment of York University. York University acknowledges its presence on the traditional territory of many Indigenous nations. The area known as Takaronto has been caretaken by the Anishinaabe Nation, the Haudenosaunee Confederacy, and the Huron-Wendat. It is home to many First Nation, Inuit, Métis communities. We acknowledge the current treaty holders, the Mississaugas of the First Credit of the Credit First Nation. This territory is subject of the Dish with One Spoon Wampum Belt Covenant, an agreement to peaceably share and care for the Great Lakes region. I am personally very grateful for the opportunity to live and work on Treaty 13 and for all that I have learned and continue to learn from Indigenous peoples at York University and beyond. Before we begin, I'd like to give you a quick update from the university. For those of you who aren't aware, I'm happy to share that York safely reopened our campuses this fall, and many on-campus activities that we've missed over the past 18 months have safely resumed, such as in-person classes, extracurriculars, and simply getting together to chat in person again. For more details on the most up-to-date information, visit our website, yorku.ca/bettertogether. Since this is a virtual event, we'd like to get to know our audience a bit better, and we will soon launch a quick poll. Today's question is, how would you rate your knowledge regarding the topic of today's presentation? A poll should pop up on your screen, and I'll give everyone a moment to respond. Thank you, everyone, for participating. It's helpful for us and our speakers to gain a better sense of who's in our audience and the knowledge that each of you have on the topic of discussion today. If you need help with a Zoom webinar, feel free to click on the Q&A button at the bottom of your screen and enter your question, and our staff will be ready to help you. The same Q&A button can be used to submit questions for our speakers or to answer during the Q&A session at the end of today's presentation. The team will watch for your questions and send them our way. Please note that all of your questions and comments are visible to our speaker and the staff working behind the scenes. We ask that you keep your comments relevant and respectful. I'd now like to warmly welcome the guest speaker of our webinar today, CEO of Wealth Insurance, Mark Halpern. Mark is a certified financial planner, a trust and estate practitioner, holds a Master Financial Advisor Philanthropy designation, and is also a proud York alumnus with a BA in Political Science from York University. Mark has held and helped business owners, entrepreneurs, professionals, and affluent families for over 30 years. Mark and his team provide tax-advantaged insurance and comprehensive estate planning solutions for their clients. He also volunteers on several professional advisory committees and teaches in his free time. We are pleased that he is able to join us today as our speaker. Welcome, Mark Halpern.
Thank you so much, Marissa. It's so great to be here, and thank you for inviting me, and thank you for the opportunity to speak to hopefully a whole bunch of York alumni like myself. This past Monday, November 1st, was actually my 30th anniversary of being in professional practice. And to think that here I am speaking for York University to people from York University and abroad gives me a lot of time to reflect and feel pretty good about it, because I don't remember a lot about being at York University other than hanging out at Founders College and the bars and the record store and having fun in Central Square. So it's nice to know that actually something did benefit me going forward, and hopefully I can share some of that with you today as well. It's actually been an extremely busy year for us. And for the last 30 years, we've been trying to convince people that they're going to die one day or get sick or retire, and nobody seemed to believe us. And it took a global plague to come along for people to be much more aware of their mortality, and also as a result, their incompletions, not having wills, powers of attorney, insurance, estate planning, tax planning. But one of those areas that we've also found is that the area of legacy has also been something they haven't been really giving attention to. And they've been donors and giving money for charity, but not really creating what I call going from success to significance. So today I'm going to share with you really what I tell clients around retirement, estate, tax planning, and what you need to know, the ABCs, but also talk to you about how you and your families can create legacies for future generations, often just by converting taxes into charity. Last thing I'll say is I did one of these presentations to a hospital not long ago, about a month ago, and the president of the foundation was actually on the presentation, and he said the following. I have to get it; it's taped, but he said, "Mark, I'm a reasonably intelligent person, and I'm reasonably knowledgeable and reasonably successful. But I only knew about 2% of what you said. How come I don't know all of these things? And how come our donors don't know that?" So I'm hoping in the short time we have together today that I'll be able to share with you things to make your and your family's lives better, and hopefully also help York and charities that you're passionate about. So here we go. I'm going to share the screen, and here we go. Okay, fantastic. So of course, the first thing is disclaimer, make sure you don't do any of this without consulting with your professionals. I've had many people try to do it on their own and unfortunately hear bad news from various members of the tax department. So please get yourself some help. Anyway, there's a lot of change that's been going on. We certainly know that we have an old new government that's come into play. So apparently they're going to try to make our lives much easier going forward by introducing a new one-page simplified tax form with only one question. How much did you make? Send it to us. Haha, we laugh about that, but we realize that there is a new reality today that all of us have to be aware of, and it really does impact what we're talking about today. The first thing is taxes are going up. That's not a question of if, it's a question of when. Money's being printed, we see inflation going up. The piper has to be paid. You could see an inheritance tax, a wealth tax, an increase in the capital gains tax, perhaps a tax on principal residences that they're looking at. So taxes are going up. We need to do something about that. Clearly, taxes are important to keep our society going, but we have to also have plans in order to try to minimize those taxes. The other reality is that most people I meet have done great. They've been investing and they've been building their assets, but it's so incredible how few have actually done any planning. Planning is to determine, can I retire? When? How much money do I need? What's my tax going to be now or in the future? Do I have any never spend money? Can I give money to charities? That's all around planning. We've also entered from an industrial age to an information age, or I call it a misinformation age. And most people are going online and surfing to find information, but this is really a very bespoke conversation. And it's really important that each person look at their own situation and get the help from a professional team. We've all heard of Freedom 55. Well, today, Freedom 55 is when your youngest child is 55. Now, we laugh about that, but it's more or less true. Our kids are getting out of school, they've got debt, hopefully they can find a job, buying real estate. It's not so easy. So they're going to be on our payroll longer, and we have to make plans for that. The good news is that with COVID and the millennials people are searching for meaning. They would like to make a difference, and they're willing to pay more than retail if there is a philanthropic aspect to that investment. So I just keep that in mind. That's really what we're going to be focusing on. And there's a program that's being introduced. You'll hear all about. It's called Willpower. It's a program that's going to be advertised all across Canada to encourage people to leave a gift in their will. And that's really one of the easiest ways to leave money to charity. But you'll hear about it, and it's going to be contact your advisor, contact your charity, or contact Willpower. But the goal there, and this is an initiative through the Canadian Association of Gift Planners, is to create $40 billion of new charity in Canada. That's billion with a B. So it's going to be very exciting. I mentioned my start in the business was 30 years ago, but my real start was actually on March the 8th, 1974. And that's when my father of blessed memory died of a massive heart attack at the age of 50. I was 11. I was the youngest of 4 boys, and my late mother, who was 48 at the time, had to go back to work to support our family. The reason is that my father was a busy engineer, and he didn't have a will, and there was very little savings, and there was no life insurance. So it was very hard for us. We had to thankfully we got OSAP and all those grants to get through university. But fast forward, I work with some of the most successful business owners and entrepreneurs and retirees and incorporated professionals and wealthy families, and you'd think they'd have it all together and all organized. But I would suggest 80% of the time they don't. They're so busy looking after everything and everybody that they haven't really taken the time to do the planning. So we help in 3 different ways. One area is we do estate planning. So making sure that your financial architecture and furniture line up. We'll talk about that. We do tax minimization strategies, often using tax exempt insurance. And then the last thing we are involved with is philanthropy, which is helping people create legacies. And we're going to talk about that a little more as we go along. And it's really about having a big picture. This session was advertised as estate and wealth planning. So we're just going to go through a very big picture here on the things you need to know and the things you need to do. So first of all, half of Canadians don't even have a will. You must have a will in order to be, that's your first step, and it has to be up to date. And otherwise, the government has a formula for how your assets are going to be distributed. And if you have a wife and minor children, it's really not a good situation. So make sure you get a will done. If you have a corporation, you have a company, or you have a holding company, you'll likely need to get 2 wills. That's a primary and secondary will. And you'll also need 2 powers of attorney, one for personal property and one for healthcare if you become incapacitated. You also have to look at something called probate taxes. And in Ontario, if you have any assets, including your house, and it's in just one person's name, just one of the spouse's name, and they die, the government's going to take 1.5% of the market value of those assets. That would include non-registered bank accounts or investment real estate or a cottage. So make sure you look at probate and speak to a lawyer about that. You might want to look at setting up a trust as a possibility. You also have to make sure that your beneficiaries are up to date on your RRSPs and your life insurance. I meet some people that their mother is still the beneficiary. They never changed it. Or their ex-spouse is still the beneficiary and they never changed it. So that needs updating. The other thing that's very important with estate planning is having an estate directory. What that is you likely know where all your things are, your bank accounts, etc. And maybe even your spouse knows where all those things are. In my case, I look after everything, so my wife really doesn't know. But what if, God forbid, there's a common disaster and 2 people disappear? Does anybody else know where all your things are? So we created an estate directory. It's a writable PDF. It's free. It's available at our website. We recommend complete it and put it someplace that somebody other than your spouse knows its whereabouts at all times. In 30 years, unfortunately, we've had many emotional events happen, and then right away there's a financial event. Where is everything? And then you need a forensics person to come in, or somebody always has that drawer to sift through. So make sure you have a proper estate directory. Life insurance, it's really important. You have to know that either you need life insurance to support a family or replace your income if you're not around, or you might need life insurance to pay estate taxes down the road, right? So that would be more of an estate planning use of life insurance. And then there's life insurance used as a tax exempt asset, very similar to other assets, but it's tax exempt. And we'll talk a little bit more about that. The good news is during COVID, the insurance companies have relaxed underwriting, and people can get up to $5 million of life insurance right now with no medical, a 20-minute phone call, and the policies are generally issued very quickly. So keep that in mind and reach out to your advisor. Living benefits. People are worried about getting sick today. So you have to make sure that you have adequate long-term disability insurance or critical illness insurance or long-term care. Make sure that you have proper travel insurance if you're traveling, or if you're interested, you should look at getting US-based healthcare products. All of that comes with planning and looking at your big picture. You also need to coordinate if you're working at a company, your group benefits and any executive compensation to make sure it's as efficient as possible. Retirement and investment planning, including government benefits, TFSAs, all of that. People, when they get to sort of 50, 60, the mindset has to go from accumulating to really preserving. That's number one, preserving what you have. Number two is getting maximum income from what you have in case you're not able to work anymore. And the third thing is tax efficiency. How tax efficient are you? So if your advisor's not doing this, make sure that you get a proper financial plan and use that as a template going forward to do all of your planning. If you're a business owner, do you have any business succession in place? Is there a key person who's going to take over the business, or is the business going to be sold? Or if you have partners, would you want your spouse, if you're no longer around, would you want your spouse running a business, and would your partner want your spouse to be the partner in the business? So therefore you need things like shareholders agreements, and they have to be funded with possibly with insurance in case of a death or a disability. And then the government does have things like a lifetime capital gains exemption that right now it's indexed, it's about 860,000, and that can be multiplied throughout all of your family members, but it has to be done with proper planning, and it should be done at least 3 to 5 years before you end up leaving your business. Banking, having a banking address to help you, making sure that you have adequate property and casualty coverage. People don't look at the fine print, they just look at the cost. And that's not really an appropriate way to be running your life, especially if you have many assets. And also we talk about aging parents. All of this that I've just mentioned, our parents have to make sure that they have all of this looked after. I won't go into case studies, but it is very important that this gets some attention. The last thing is charitable plan giving. And you'll see it's in bold. I talk to everybody about that. Clearly, charity begins at home, but there's some great ways for you not to be in a situation where you're disinheriting your children. You can actually be adopting a charity and disinheriting the tax department. So keep that in mind. This is very important. This really a retirement and estate planning. Most people, they grow their assets, and at some point in time, they're going to start accessing that money at retirement, and they'll start encroaching on that money. Or if they're really good investors, the estate will always stay the same or actually appreciate. Most of my clients, interestingly enough, that they're probably going to be worth more when they die than what they're worth today, which means that they're sitting on a whole bunch of money that's meant for the next generation. So as the custodian or trustee, they have to realize that they're partnering with the tax department on that money. Therefore, everybody needs to have a plan in place to say, okay, my retirement, check mark, I'm good. I can give money away to my kids or to charities along the way. Here's my tax at the back end, but here's a whole bunch of money I'm not spending that I'm just paying taxes on. With proper planning, you can use some of that money to preserve the estate entirely for your family or for charity, or for both. But that's where the planning comes in. And that's because we have a lot of taxes. Here's just an example. Most people don't even realize how much taxes or what's taxable in their assets or their estate. And it's not unusual for me to meet somebody who's worth $10 million for me to tell them that they're only worth $6.5 million, which doesn't make them feel very good, but certainly allows them to plan now. But that's because they haven't looked at what are the taxes. And here in Ontario, here's just an example. RRSPs, RRIFs, pensions are taxed at about 54%. So unless you have a spouse, remember, all your assets in Canada, if you have a spouse, everything on death will roll over to your surviving spouse tax-free. The taxes are only due on the second to die of a husband and wife. But in that case, registered assets are taxed very, very an exorbitant number. If you own shares in any stocks, appreciated securities, or investment real estate, not including your principal residence, or you have a business. The government wants to get 27% of the gains that you've had. If you have money sitting in a holding company or an investment company, there's a tax of anywhere between 40 to 70% without proper planning. And then, of course, there's passive income tax if you have money that you're investing in your corporation. And then we talked about probate as well, of being 1.5%. So it's a lot of money. And you could be worth $50 million and feeling very, very confident. But when you find out you're only worth 40, that gets you a little bit more nervous. Listen, I'd like to be worth $40 million. I'd have no problems with that. So here's where we get exciting in terms of going forward. Each one of us has 3 possible beneficiaries for our estate. You have family, you've got the tax department, and you've got charity. And each of us can only pick 2. Which 2 would you pick? Most people would say family and charity. Well, with proper planning, you can be remembered for giving a large check to charity as opposed to writing a big check to the tax department. And this is a very important point because, you know, this is one of my favorite quotes. We live in an amazing country. Yes, it's turbulent and times are changing, and taxes are what really keep our economy and our social services going, including York University. And we must pay taxes, but there's no law to say that you have to leave a tip. That's what we're talking about here. So what we do is we create what we call accidental philanthropists. What's an accidental philanthropist? Well, there are 2 kinds of people in the world that I see. There are some who are very generous, and they just develop that throughout their education at home. Their parents were generous, they're generous, they like to give back. And then there are those people who didn't necessarily get that education. When those people find out that they have a choice where their taxes go, well, suddenly they become what we call accidental philanthropists. And the people on this side can now give more at the same amount that they were willing to pay, or they can give the same amount at less cost if they do proper planning. And here are just what we call the best accidental philanthropists. And maybe you will identify yourself here, or you'll identify somebody that you know. Widows, divorcees, and singles are really have to give this attention. Why? Because they don't have a spouse to roll over all their assets. So they're one incident away from a very large tax disposition. Anybody who's sold in the last year or will be selling a business or investment real estate or appreciated securities, that's the year they're going to have their biggest tax. It's also the year that they can be their most generous to offset those taxes. Anybody that you know who've done or will be doing an estate freeze, another great way to donate private shares and do something wonderful for charity. We'll talk about this in a moment, but if anybody has a tax bill that's going to be due in April and you own appreciated non-registered securities today, there's a wonderful way for you to create charity and offset taxes in the future, which we'll talk about. If you have a foundation or a donor advised fund, there are ways to create transformational charity in that foundation. Or if you have an old existing policy that you no longer need, that can also create philanthropy. Or you know there'll be an estate tax bill on death, great, we can be philanthropic there as well. And if you've already left a gift or a request in your will, there may be ways for you to amplify it. So consider becoming an accidental philanthropist. Here's simple math. And we're going to assume that everybody's in the high net worth tax category. But here's the simple math. Every $2 that you give to charity, you save $1 of tax. So $2 to charity and you save $1 of tax. And what happens is the receipts that you get, the charitable receipts in any given year, can be used to offset 75% of your annual personal income tax that's due. 75%, never 100%. But the good news is those receipts that are over and above the 75% can be carried forward for up to 5 years. So you don't lose them. They're very good for you to use. The thing you should know is at death, receipts can actually be used to offset 100% of estate taxes, including going back the prior year on your tax cycle. So charity at your demise is a great way to save taxes and create charity. So here are just a few gifting options we'll go through. The first one is gifting in a will, a bequest, using your RRSP or RRIF beneficiary designation, gifting securities, or gifting life insurance. So let's talk about your will. So one thing you might want to do is hopefully have a will. And if you haven't, or you want to change your will, you should include a gift to York for a specific amount or percentage of your estate. they'll recognize you, York University, for your legacy gift today, as opposed to waiting for it to happen at the other end. If you share that information with Marissa, it's a great way to do it. But if you don't want to change your will, then if you have any RSPs or RIFs, you can notify your financial institution and get what's known as a multiple beneficiary change form and indicate a certain percentage or dollar amount to York or to any charities that you're happen to be passionate about. Why do I mention RSPs or RIFs? Because as I mentioned, this is really what I call the biggest tax time bomb, and where, again, widows, divorcees, singles are disadvantaged. If somebody has $2 million in an RSP or a RIF, which is not unusual for successful people who have built up their lives, first thing you have to realize is their $2 million RSP is only worth $920,000 to your heirs because of that 54% tax. So it's only worth $920,000. And at death, all of that, again, will be taxed at 54%. So we're gonna talk about a couple of strategies, at least one of them, where you could donate some or all of your RSPs to charity and save taxes for your family and actually get more money into your family's hands versus not including charity. We talked about different ways to give, but most Canadians, when they give cash, checks, or credit cards. Cash, checks, or credit cards. But you have to know that cash, checks, and credit cards are the most cost inefficient way to give. And really, there are better ways to give. And one of those is by donating appreciated securities. This could be stocks, mutual funds, ETFs, segregated funds, anything that's non-registered. And we all have that sitting in our portfolio. And if you've had it for the last 10, 20 years, it's doubled, tripled, whatever, it's up very high. So here's somebody who used to give $50,000 of cash annually to charity. So they have to make 100, pay tax, so now they have 50, they give to charity, it saves them 25,000 of tax. But they're sitting on some shares valued at $50,000 that cost them only $10,000. So there's been a $40,000 gain, capital gain, and that's taxed at 27%. So if you sold those shares of $50,000 in shares, you'd actually only take home less than $40,000. But the government has gone ahead and said, no, if you want to donate, you can donate appreciated securities and there's no capital gains tax. They waive that and you would get a charitable receipt for $50,000. So this is a perfect time for us to be having this conversation because it's an end of year strategy. Consider donating to York University now, stock or mutual funds or ETFs or segregated funds to offset the taxes, no capital gains, and offset your taxes that are going to be owed in April. Now, it's sad to say, but very few people are doing this in Canada, and it's been around for years. So it's something really to consider because remember, that capital gains tax doesn't belong to you. So in this case, that person had $50,000 in shares. They're only worth $40,000. Now you're giving it away, you're saving. Anyway, it's a wonderful thing. Speak to your professional advisor about it. It even works nicer if you've got a corporation, a holding company, an investment company, because then it can be leveraged even more. So in this case, the company, they still have the same shares, $50,000 in value, $10,000 cost base, $40,000 capital gains. The company donates the $50,000 in shares. It's a deduction to the company, which now also reduces the company tax value, which is great. But here's the best catch. The gain, the $40,000 capital gain, actually gets credited to the company's CDA or capital dividend account and can be withdrawn tax-free. That's $40,000 that would normally be taxed at 50% or 20. So you'd only get 20,000. Now you get 40,000 out. So think about this. If somebody has sold a business or they're selling a large portfolio, we'll talk about a couple of case studies there, or they're selling a real estate or a business, that's the year to make your biggest contribution to charity. Donate it to charity. It turns your taxes into charity. Then consider maybe using life insurance to replace the money that you donated back to your family for pennies on the dollar. So again, it takes some planning, but definitely don't overlook it. We don't have a lot of tax shelters left in Canada. Well, I'll call these the final four of tax-free opportunities. One is your principal residence. Whatever you paid for it and it grew and you sell it, for now, it's tax-free. TFSAs are tax-free, but it's very limited. It's only $6,000 a year. Lottery winnings are tax-free in Canada, so don't buy your lottery tickets when you're down in Florida. There, they'll be taxed. And tax-exempt life insurance is also one of the final four. That means everything else that you own in your possession there must be somebody at the CRA that you love, because they have their hand out and want anywhere between 27 and 50% of whatever wins you've had or any success you've had, except for these four. So let's find out certainly about how life insurance can be used to better your family situation. This is just a comparison of the after-tax cost of a donation, just to show you that not all donations are the same. Here's an example of somebody giving $1 million. Again, this is all scalable, either giving cash of $1 million, giving public company shares with a zero cost base, or using flow through shares, which we'll talk about, or using life insurance. All of them are the same at $1 million. But the key here is that if they give cash, it's about 50 cents cost for every dollar of donation. Giving those shares, it's about 23 cents per dollar. The flow through shares, depending on what jurisdiction you live in and what's available, they can be anywhere from 5 to 15 cents per dollar. And then the life insurance is at 12 cents per dollar. So you can see here that really it's important to see, if you're going to be generous, at least do it in a more efficient way. So one way of doing that is by gifting life insurance. Many of us started off in life where we have old furniture. It could be an old insurance policy of 100,000, 250, 500, whatever. It might not move the dial now in terms of what our family needs or for when we took it out. It could have been that it was for, those were the days you had a mortgage and you had young family and kids' education, etc. But those policies can be very, very valuable. I'll give you an example. We had somebody who just had $150,000 life insurance policy, and they were able to get a fair market valuation from an actuary on that policy of $87,000, meaning that $150,000 policy is worth $87,000. They then donated the $150,000 policy to charity and received an $87,000 tax receipt that saves them $43,000 of tax. Going forward, the premiums they're going to pay are considered charitable donations. But the beautiful part is they're recognized for giving $150,000, but they've saved a whole bunch of tax, and they're saving tax going in the future. And the charities will recognize people today, as opposed to waiting until they die, for a nice legacy gift like that. Another way of using insurance is buying a new policy. You want to give a gift of $100,000, $1 million, whatever it is. Think about it from the estate planning point of view. Imagine somebody has a $500,000 estate tax. Why not consider getting $1 million life insurance policy for pennies on the dollar and have the beneficiary of that be a charity? So upon death, the charity gets $1 million. That creates a receipt that offsets the $500,000 of estate tax, and you're remembered for giving $1 million to charity as opposed to $500,000 to the tax department. And the easiest thing, if you don't want to change or do anything, and you already have existing insurance in place, so you might want to go ahead and just change the beneficiary on your policy and include a percentage or a dollar amount that you'd like to give to York or any other charities that you're passionate about. That's the life insurance story. But here's one other part of the life insurance story, if I can get to it. This is an example. Look on the left-hand side, not on the right side. This is a 60 and 58-year-old couple, and they have a corporation, and they're investing $100,000 every year after corporate tax for 15 years. So they're putting away $1.5 million over 10 years. And we're going to assume that they're earning 4% on that money. So putting away that money for 15 years, and 30 years later, their money hasn't even doubled. It's only at $2.3 million. And that's because they're part of the tax grind. On the right side, it's the same couple, but they're saying we'd like to shelter $100,000 a year for 15 years. So the same $1.5 million. In order to do that, they need to buy a life insurance policy. This is a joint last to die policy for about $2.5 million. So they put away the same $1.5 million, but at the end of 30 years, they've got over $4 million. So we've created for them almost $2 million more than what they would have done on their own. So their family would still get what they were planning on, but now there's more money to either give to family or use for charitable purposes. So it's something that really you should be looking at as far as your planning. Other giving strategies, we talked about foundations. Well, you could set up your own private foundation, but that's really for people who want to put away, $2 million to $5 million and control that foundation. and their startup costs and annual reporting and whatnot. But there's something else that people are not aware of, and that's something called a donor advised fund. These are funds that are set up by community foundations like the Toronto Foundation, the Barrie Foundation, the Kitchener Community Foundation, Oakville Community Foundation, where you use their umbrella and you put your named foundation under them. There's no setup fees. The costs are very, very minimal, but that's where you can do a lot of your charitable giving and receipting. And that money can be now used to give to any registered charity in Canada. I really recommend you find out about those. It's really remarkable. And you can do this with your investment advisor as well, using an organization like Canada Gives to manage, or at least to provide the umbrella. We talked about flow through shares. If you're already giving charity, flow through shares just allow you to give charity at the least cost possible, which means you can give more than you were based on the amounts that you were willing to pay, or you can give the same amounts at less cost. Charitable gift annuities are very huge in the States, but they're for people who are looking for an income on their money. So imagine giving $100,000 to charity and it gives you a 6% return every year for the rest of your life, but also gives you a charitable receipt for a good portion of that donation. In the States, there are billions of dollars in this, but if you're looking for cash flow and ways to work with charities, that's something to consider. Charitable remainder trusts are just a way of getting a charitable receipt today for, let's say, the donation of a house or a property, which you get to use during your lifetime, but you get the receipt today, and upon your death, the ownership of that then would revert to the charity that you're involved with. CPP philanthropy, we're going to just talk on that for a moment. This is something we came up with back in 2017, and that is in Canada, when you turn 65, you can take it out earlier by 60 or by age 70 and get more. But basically, a 65-year-old couple is entitled to get around $26,000 a year when they retire from the government. That money is fully taxable. And if you're very wealthy, you'll pay the tax, you'll reinvest it and be taxed again and again. That's how it works. But if you're philanthropic, why not use the government benefits to create some charity for causes you care about? You could take that $26,000 and acquire about a $1.5 million life insurance policy. If York or another charity is the owner and beneficiary of that policy, your $26,000 of CPP is considered a charitable donation. You pay no tax on your government benefits, and you're recognized for $1.5 million gift. Of that policy, and instead donate your registered assets. So instead of your family, remember on that $2 million example, only getting $920, now they're getting $1.5 million, and you're giving $2 million to charity, all by using your government benefits. Kind of neat. ROP, return of premium life insurance, is a way where you can buy a life insurance policy for charity, and upon your death, your family gets back all the premiums you paid. And the last one, which I think is very important, is something we call policy preserver. In Canada, there's billions of dollars of term life insurance that actually falls off the books every year because people get older, becomes more expensive, or they don't need it, and they drop it off. But those policies can be converted into a permanent insurance policy without any medical evidence. And then you could donate those policies to charity and get a charitable receipt for them to save yourself some taxes. And in some cases, there are charities that would actually fund those policies going forward. So don't let those policies fall off the books. There's actually some great value there. So make sure that you pay attention on that. Just a few case studies. And I want to make sure that we have time for questions. I met with a cardiologist. He was a single guy, almost 60, who had a corporation. And it turned out after we did all this work, it seemed like he had too much insurance and he wanted to cancel a policy. And I said, Jonathan, you're a pretty charitable guy. Why don't we donate that insurance? And sure enough, he did. He donated to 4 different charities. So South Lake Hospital Foundation wrote him up in their foundation magazine about the cardiologist with heart. And another community foundation recognized him in their book of life, which recognized about 24 philanthropists who did legacy gifts to that charity, and he was recognized for that. So I remember getting the article and I said, Jonathan, this is a great article. Where's my name exactly? Like, of course we laughed, but there wasn't a chance in France that he would have done any of that had we not shown him how easy it was to do that. So really, it really is incumbent to look at your big picture and see how things can work, certainly with what we're doing here. If somebody has sold a real estate or they've sold a business, it's a great way to, that's the year they could make a donation and get all the money back that they made on that donation back to their family. If they've done an estate freeze, a great way is donating private shares. And as far as RSPs, it's a great way you can, if you don't need those RSPs or those RRIFs, you can actually donate those to charity and turn them into charity. Last couple of slides, and then we're going to open it up for questions. There are different givers. Some want to be anonymous. Some want to set an example for others. Other people give because they want to be remembered, and others do it because it's great for business. You know, there's great ways to give $1 million gifts that only cost you, you know, let's say $50,000 over your lifetime to give that through an insurance policy. Last thing I'd say is, you know, if I asked everybody on this call if you knew the names of your grandparents, you'd probably say yes. Most people do. But do you know the names of your great-grandparents? Most people would not. This is actually a picture of my great-grandparents, Aaron and Liba Gross, in 1934, unfortunately before they died in the Holocaust. But imagine on January the 1st, you received an envelope in the mail. Inside there was a check for $10,000 from your great-grandfather. You think you'd remember their name? Successful, but I'd like to become significant now, and I'd like to pass that legacy along to my children. All it takes is a bit of your attention and time. But with that attention and time, there's amazing things that you can do to benefit society and really benefit your family and actually benefit yourself from a tax point of view. So next steps, I have a 48-hour rule. If anything we talked about today really resonated, get on it within 48 hours. I heard from somebody yesterday that heard me 2 weeks ago. They said, sorry, it took me so much longer than 48 hours. But speak to Marissa Barlas. She's great to help you organize something special for York. If you're interested, I have a whole tax letter digest, over 100 articles and a bunch of one-pagers on outlining all these concepts that we spoke about. Please send me an email, mark@wealthinsurance.com. I'll be happy to send that to you. Please connect with me on LinkedIn. I'm posting always about charitable and philanthropy. And please watch my TED Talk at Idea City on the new philanthropy. I think they'll put that in the chat, but it's I think it'll really give a great framework for what we're talking about, and learn about it and speak to your professional advisors and collaborate, but don't ignore it. There's just too much riding on the line here. And lastly, just consider your own York legacy gift. Here's an example of $1 million life insurance policy purchased on a single person, not a joint last to die, but single person healthy, where they're paying for the policy for 10 years only. And here are the different ages, and those numbers in yellow are the after-tax costs each year over 10 years in order to make a significant contribution to your alma mater. So keep that in mind. And that is that. That would be what I have to say today. I'm gonna open it up now. I think we have in the chat the TED Talk, which I think everybody would love. And at this point, I would like to open it back up to Marissa to lead us in some questions.
Thank you, Mark. Thanks for taking the time to host today's webinar and share your wealth planning tips and strategies while certainly making an impact on the lives of others. I've learned some new ways to certainly leave a special legacy for both my loved ones and my favorite charities. And whether here at York or in support of other nonprofits, legacy gifts certainly do make the world a better place. So yes, in terms of our Q&A, let's go ahead and open the floor to our audience members and begin taking questions. I'll remind our guests that if you have a question for Mark, please feel free to enter it in the Q&A section at the bottom of your screen, and we'll do our best to answer as many questions as possible. Our first question from one of our guests is, what is the best way to transfer real estate to children? For example, the family cottage.
The family cottage. The first thing, just high level, is that that people have to realize, when they die and there's no spouse, right? So the government wants money, right? You either have the cash. Think about the cottage for a second, because most cottages have appreciated, if they bought it for $250,000, now worth, $1.25 million. So there's a $250,000 capital gains tax there. So they need either the cash to pay it, or they have to borrow money. So they have to leverage the cottage to come up with the money to pay, but it's not deductible interest. Or unfortunately, a lot of people actually have to sell the cottage in order to come up with the taxes, which is crazy. That's like selling the cow that's giving the milk. Or one way of taking care of the family is using life insurance to come up with the money that will have to be due for taxes down the road. That's the easiest way to do it. Okay. So that's one on the estate planning side of it. If along the way, there are different ways that you could set it up, you don't want to go ahead and just change the title to some children, because then there could be a possible disposition. And now also the property is actually legally owned by them. So if they have any issues around spouses or litigation or creditors, that's now an asset of theirs. And going forward, the gains are also going to be credited to them as well. So that's something you have to also consider. And then the third way to do it is possibly by setting up a trust. And that would be by putting the cottage into a trust, in a trust for the kids. But again, that's a little bit more complex, but done all the time. And really recommend that you speak to a competent lawyer who specializes in tax and estates to take care of this. If anybody's interested, I have a whole tax letter article on options for how to take care of the family cottage, and I'd be very happy to send that to you if you send me an email to mark@wealthinsurance.com.
Great. Oh, I didn't know that. That's good information. Let me see. Our next question is, I think you've already touched upon this, but why is life insurance so important in estate planning? And a secondary question is, could you please explain as simply as possible the main differences between an annuity and a life insurance plan?
Whoa. Okay. So I'll give you an example. I was on a phone call yesterday with an accountant who was actually the executor of one of his family's estates that he was working with. And the estate was all real estate. So that means it was an illiquid asset. And just to let you know, right now, probate court is way behind. And all of the tax side, because of COVID, it could be 6 months to a year, whatever. But at that moment, everything is frozen, which means the estate has no money, no cash. He said the client happened to have a life insurance policy, and he filled out the death claim. And within 2 weeks, he had a check in his hand, tax-free, of cash. Well, all the other assets are illiquid. So the first thing you have to know is insurance is a very liquid asset to have. It creates the money you need when it's really necessary or when it's needed. So it's not a be all and end all. You have to look at it in scheme of all of your planning, but it really is. It can be used for, let's say you have let's say you have that a cottage and only one of your children is using it, but there are 2 other children. Well, it wouldn't be fair to leave that cottage to 3 kids when only one is using it. So then why wouldn't you use life insurance to make sure that the other 2 kids are made even when the house, if it's a $3 million cottage. So this person gets $3 million and these 2 kids get the equivalent, let's say using insurance. That would be an example. So there are many different ways, but each situation is unique. As far as the question on annuities and life insurance, annuities are really, make it very easy description. When you think of it's a way of generating an income on your money, which is primarily paid back to as principal and not as much interest, which means that they can be very tax efficient. Think of an annuity as almost like a mortgage. With a mortgage, you buy a house and you borrow, let's say, $1 million, and you pay every month an amount of money of principal and interest. With an annuity, you use that $1 million of cash and you give it to an insurance company, and they give you an income throughout all your life, made up primarily of principal and some interest. So it can be very efficient that way as well. Really needs a lot of attention, and that's really an income thing. whereas life insurance is normally a lump sum. Now, one of the options with a life insurance policy, though, is you can actually have a life insurance policy purchase an annuity for your beneficiaries. So now they have an income going on for the rest of their life, as opposed to having a big chunk of money in their hands, which could get squandered or attacked by, people of ill repute or people around that you really don't need. And maybe they've got your kids have some issues around that. There could be people who have addictions. It's just a way of protecting that money for your family.
That's great. Thank you, Mark. Our next question comes from Rose. What happens when one spouse passes who had children before that marriage and now owns a home with the second spouse?
Well, that's where a will really becomes important. I just got a call from somebody just before this meeting at 11:30 with the same situation. It's not unusual to have second marriages, which means that you have children from your first marriage and your new spouse has children from their first marriage, and you want to make sure that your kids are looked after, but obviously you want to take care of your current spouse as well. So that's really where insurance can come in as well, and planning. Certainly you'd want to give to that new spouse things like the principal residence, and you'd also like to give them things like your registered assets, your RRSPs and RRIFs, because if you leave that with your kids, that's going to be taxed at 54%. So leave the house and leave the registered assets to your new spouse, and then maybe use insurance again to equalize things for your children outside of the relationship. Now, very important that you have a will and it's up to date. I've met many people who still have a will and their older ex-spouse is still the beneficiary on their RRSP or the beneficiary on their will. Scary stuff. So hopefully, Rose, that'll answer your question. Speak to a proper lawyer who specializes in tax and estates, or if you need a referral, I work with some great people.
That's great. Okay, we have time for just one more question. This one's from Gary. What is involved with leaving a home to adult children living with the parents? Would it still be the principal residence as the kids have never owned a home previously?
Yeah, so first of all, we don't have a tax if you leaving your house to your kids. There's no tax on that, right? So they would now be the owners of the house, I'm assuming. And again, you have to be very careful. Maybe it should be owned in a trust. Like, again, we're concerned, what if your kids get married and divorced? Now suddenly that house, it could be encumbered in a sort of in a divorce settlement. So it really does require speaking to a lawyer. But once they now are the owners, they're the owners of the house. And if it's their principal home and it's two kids, so now they both are owners, co-owners of a principal residence. So there'd be no tax going forward. The issue is if your kids also own a condo or they own another house, now all of a sudden the house that you left them is considered an investment property. And as it goes up in value, they're going to be subject to capital gains taxes. So it's really important to look at the big picture.
For sure. Well, thank you, Mark. That's great information to know. Thank you to our audience members for engaging Mark in your questions. I hope that the information and the tips and strategies that Mark shared with us today were helpful to you. And if you'd like to explore any of these options further, I'd certainly encourage you to speak with Mark or your financial, your wealth, your tax, and or legal advisors to see if any of the ideas presented here today may be applicable to your own unique situation. Thank you, Mark, for sharing your wills and wealth wisdom with us today. It's greatly appreciated.
Thank you, Marissa. I just want to end with just one last thing. Most important thing is take care of all of this while the sun is shining. We've never been in a situation of so much change and risk. Take care of it as soon as you can, because it leaves you much more options and really shows the love that you have for your family and for the charities that you care about.
Absolutely. Well, thank you once again. And for those of you interested in more about this area, there will be one more event as part of our special life skills series. Our next Wills and Wealth webinar is taking place on Tuesday, November 30th at 12 noon. And it's entitled Where There's a Will, There's a Way, Estate Planning Mistakes to Avoid with estate lawyer Maureen Berry. The link to register for this event will be shared with you in the chat feature. And to learn more about this event or any legacy information, please feel free to visit myyorklegacy.ca. And that concludes our event. Thank you for being here with us. We hope you enjoyed today's event and be well.